Please. So thank you everybody for joining us. We're recording this for those that can't attend. This is the second cohort-wide get-together. As I was explaining, we're going to run around each of the regions and do a quick recap and expression of the thesis for each region. We're then going to have a short session run by me as to what to expect over the next 6 to 7 weeks, what field trips and investor sessions might look like. But the majority of today is actually going to be spent understanding a bit more about the other side of the table, the negotiating table, and what the market updates looks like. So I'm going to ask Weston Murray to kick off. Jack, are you there, or am I throwing you under the bus and you're taking kids to school or something other?
No, I'm here. I'm just trying to get my camera to work, but if it doesn't really matter. So I might start in earnest anyway. I was going to read from our the strategy sheet, the description, but I pretty much know it off by heart. Where we are is an natural inland delta of the Murray River. So our area extends from Moama to Tooleybuck along the New South Wales side. So we're in the southern riverina. This has some an enormous public and private investment in one of the most sophisticated gravity-fed irrigation systems in the world. And we have both dry land and irrigation, cropping and livestock enterprises. But what we also have is a internationally recognised biodiversity hotspot, where we have we're within 3 sides, if you like, of a Ramsar protected wetland complex. So along near our property and others, there is the Kundruk Parakuta forest, which runs along the river and obviously on both sides. And then there's the Wirrai to the north, and we have the Barmah to the east. So we have a number of almost, I think there's maybe one that would like to rehabilitate a wetland area, but many of our cohort have on-farm wetlands that have been looked after, and it could be a place for even more restoration. We're also linked by this to these the national estate. So we did quite a lot of work recently on a biolink, and we got some experts. We had Barappa people and ecologists. Woody was part of it, and land carers and wetland experts to help design a link, a hydrated biolink. So we worked with Maloon, and this is something that we're all keen to explore as well. Is that could this be could this concept be a product that would be of interest, a hydrated biolink that has biodiversity and carbon sink qualities to it? So in this landscape, there's a lot of opportunity here because of water, a lot of risk too because of water reform, and we've been ground zero for some of the worst socioeconomic effects of water reform over the last 15 years. Some of the interventions that we're looking at is planting mixed species. So we'd like to link in biolinks and having a look at carbon sinks that have mixed species, have a lot of biodiversity in them, and are good for the functions of biolinks, which is to improve the genetic diversity and the range for different species. So we're also looking at our farm dams and our wetlands, and really interested in furthering teal carbon trials and seeing whether we can, mitigate some of the methane liability that they're telling us that we have. These badly managed wetlands and old dams can be methane stacks. We want them to be methane sinks. As much as we would like to be a carbon sequestration sink as well. So it's fencing to keep off invasive species, to the restoration that we're keen on doing. So those are the main interventions at this stage: is mixed species planting, looking at farm dams and our on-farm wetlands, and potentially restoration of ones that have been degraded over time before our time, and fencing.
Well done, Jack. That was brilliant and concise, and you've set a really high bar. Thank you
Thanks.
for introducing everybody to Western Murray. Southern Tablelands. I can't see Kathleen Allen, who is the cat herder for there. So Mel or Tom, may I ask whether you'll step into the brink on behalf of the group, or
Yes, I'm here.
hey, Mel.
Oh, we're all here, but I'm happy to join in. So we are on the Southern Tablelands of New South Wales. So our group is focusing on the area of Burra, Upper Lachlan and Yass Valley local government areas. So we pretty close to the ACT border, and yes, our main rivers are the Burra, Crookall and Yass, and the Upper Crombie to the north of us. And our region is a very strong agricultural region with beef, cattle, sheep, wine and grain production. So our Pilot 10 group are mainly sheep and cattle farmers, and we're ranging from a few hundred hectares up to 3,500 hectares in our group. And yeah, certainly looking at the opportunities that in soil sequestration and biodiversity markets. We have an average rainfall of around 650 mils, and our landscape does vary quite a bit from highly fertile soils for intensive agriculture, but also areas that are highly erodible and also prone to salinity. And we do also have a diverse Aboriginal cultural landscape with many significant places within our part of the world, and working with 3 local Aboriginal land councils being Cowra, Onawal and Peja. So our interventions that our group have been looking at to focus on, the first one being environmental plantings. So this would be using the methodology of the carbon market through the Emissions Reduction Fund. So looking at carbon sequestration, improving boxgum grassy woodlands, which is our predominant vegetation community here, which is a critically endangered community. And we also have a fair bit of dry sclerophyll forests and other vegetation types. So looking at that to generate ACCUs through that market, to reduce emitters' carbon. Being cattle and sheep producers as our target in our group, certainly looking at sequestering soil carbon through improved grazing management, particularly with time-controlled grazing management and using grazing charts. So certainly looking at that to sequester carbon, but also to get those co-benefits of improving soil health, water retention and pasture production. So again, that would be through the ERF methodology. And then all of our landholders are also very interested in the biodiversity markets that are starting to open up now. So looking at improving biodiversity, both terrestrial and riparian. So that's doing fencing, planting, also grazing management to increase ground cover, reduce erosion, and also the identification of cultural sites. So this will be again to improve boxgum grassy woodlands and riparian zones, looking to protect threatened species. So we have quite a lot of threatened species with woodland birds, aquatic species, mammals and reptiles, and improving water quality, improving dam water quality, and reducing that methane, as the Murray region spoke about, and also again that protection of cultural sites. So market opportunities, certainly looking at biodiversity conservation agreements such as the BCT, the biodiversity credits market, through the Biodiversity Stewards Agreement, nature repair market, and potentially some water markets as well, but we're still kind of looking into that. So that's a bit of a summary of where we are in the Southern Tablelands.
Thank you, Mel. I might just ask, one of the things I recall vaguely was we have a couple of high priority corridors in existence that make sort of rungs on a ladder. And I think
Yes.
your farmers have identified that potentially they run north-south, like a second side to those rungs in a ladder, giving...
So part of the Great Eastern Ranges, which has been identified from Queensland down to Victoria. So we've got the Canangra Boyd to Wyangla link, which runs east to west. So that runs at the northern part of our area. And then, certainly looking at the mapping, we have a significant amount of corridor running north-south. That sort of connects it all as well. So that's, so we do have some significant biodiversity assets in our region already that we can certainly build on and work to connecting those up as well. Thanks, Waddy.
Brilliantly done. Another hard act to follow, but I'm going to throw now to Perko for the Upper Clarence, please, mate.
Thanks, Waddy. Yeah, we're in the Upper Clarence, so we're sort of all in the Tenterfield Shire, but some of us are right up on the Queensland border, I suppose, so it's closer to Stanthorpe. So it's north, largely north of Tenterfield. Our group is largely the headwaters of the Clarence River. We've got one member who's in the headwaters of the Murray-Darling, but most of the group are in the real headwaters of the Clarence. So what we're aiming to do is have an impact on that river in a range of ways. So that's to do with, say, carbon, biodiversity, water management. It's all grazing largely. There is a little bit of vegetable growing in our area. There's quite a lot of national parks and state forests. So the remnant vegetation and surviving natural bush is quite a high percentage. So one of the things you want to do is try and maintain that across the whole region. We're largely looking at regenerative grazing practices that'll deliver carbon, biodiversity, probably water benefits. Riparian management that'll deliver pretty much the same, really. Biodiversity, water, carbon. Vegetation management, so that's sort of thinning or managing what vegetation and regrowth that we've got, and erosion control. So we're largely looking at delivering carbon, biodiversity, and hydrology across our catchment and then down into the Clarence River. And our one Murray-Darling member is looking at doing the same thing, but in the headwaters of the Murray-Darling.
Thanks, Perko. And I think it's really sort of incumbent to say that it's a pristine part of the environment that Southeast Queensland, Northern New South Wales has high rainfall, large existing tree densities. It's home to a lot of the furry species that Australians love, like koala, sugar glider, etc. And it's mainly through the protection and management, regeneration by farmers that we can lock in and secure those endangered species and having them have a home into an ever-changing climate. So very exciting stuff. Northern Rivers, Joe, Gav and Deanna, I'm not sure who to throw to as the mouthpiece for you guys. Do you want to quickly look amongst yourselves and nominate?
Oh, look, I'll have a go to start with, but I must admit I'm a bit hazy on a couple of details. I have my head in dung beetles, not literally, but just doing a lot of work, dealing with a lot of shit. But essentially, yeah, Northern Rivers, we're quite a diverse area. I don't think we have, a defined landscape. We're basically covering Bundjalung and Yagle country, which is the Richmond and the Clarence catchments, two big catchments, the mid and the lower of the Clarence, so connected to the Upper Clarence group, very much so. by water, and I think our biggest theme, I think Joe and Deanna would agree, is water, and it's a big issue up here in terms of just the quality of the Richmond River, which is pretty poor, and is rated as such, and there is quite a bit of intention of investment into improvement of the Richmond River. So I think that's where, and so I can't remember who came up with the term, but it was fishable, swimmable, drinkable. We've got Richmond River Keeper. We've got a couple of Indigenous led groups doing a lot of work on water and on country. We've got DPE. We've got various, and then we're fortunate in our group that Joe's involved with the Casino Food Co-op, and they do quite a bit of work around their River Crystal initiative. So I think for us, everything points to what we can do over a large scale to improve water quality. Pilot tin graziers, probably, not many are on a really large scale, but we're all primary producers. There are veg carbon opportunities, and soil carbon maybe in an aggregated model, but I think it's fair to say there's a healthy skepticism around ERF projects at present. I guess some proof and some understanding of the business cases of investment versus return would be appreciated, and I think it's even vaguer with biodiversity markets at present. The biodiversity on Northern Rivers has been supported through various NGOs in different ways, but it's very scattered, and it's hard to get a sense of people working particularly collectively in a strategic way, which is a bit unfortunate. What else would I add? So in terms of water, our actions would be around management of the riparian zone. Environmental plantings the environmental plantings method, ERF, looks good on paper, looks like it really suits the scale of landscape. And if you can't grow carbon in the Northern Rivers, I don't know where else in Australia you're going to be successful. So I think that is an opportunity. Some people are doing it a little bit, and there's some soil carbon projects as well, but the data is they're not transparent with the data, so it's hard to pick up what's real at present, very early days. What are we, 1,200, 1,800 mil rainfall variation across, so high rainfall area, except when it isn't, when we have regular dry and drought periods. I think landscape function's probably our big thing to improve our river, and it's working out what are the things we can do for landscape function.
Brilliant, Gavin. Opportunity for Tanya, Joe, Deanna to fill in any pieces you think might be required. I see Deanna saying no. Tanya? Joe, can't see you, but I'm sure you'll speak up if you want. All right. Look, thank you everybody for hearing out and doing that muster. It's fantastic and exciting to start this year with so many great opportunities to make an impact on the landscape, to help locally individual farmers to improve practices and productivity at a farm level, but also to see them being able to coordinate and get the benefits of aggregation, so that at a landscape level, we might actually achieve things like hydrated biolinks or connectivity between existing biodiversity assets like we've got in the southern tablelands, or really ensuring that those high altitude, high rainfall, high biodiversity, pristine areas in the northern part of our state are protected and continue to be well managed, and that we can handle better the rainfall and the variance in rainfall, so that floods and droughts don't have those sort of economic and environmental impacts that we've seen really highlighted in the last few years. So I couldn't be more enthusiastic about what we're doing collectively as a group and what each of the individual groups are up to. The first 6 weeks of what we did towards the end of last year were really about helping us to define a thesis about, well, what is it that we're doing? And in that definition, we all established our working groups and we got our pilot farmers established and committed. We've all done our mapping sessions and had our individual reports. During that definition, digital onboarding was done. We've identified the collective and individual outcomes and the sort of interventions that we can see that are worthwhile doing. The next sort of 6-week stretch, if you want, is about testing that thesis. And we test it in a few ways. So we want to know, well, what are the things that need to be done in order to support that habitat or that environment? When you do an intervention, what are the activities on the ground that a farmer might need to consider? And so you not only want to test whether that's real by going and seeing examples of that, by doing some in-field observation, going and doing a field trip to where those sorts of interventions are already existing in your landscape. Go and speak to the farmer or the landholder and ask about the pros and cons. But you also want to get expert opinion in at this point. And you want to start to use some of the budget that we've provided for each group to bring in expert ecologists or hydrologists or experts that are relevant to the sorts of needs of each of the groups. And the third bit of testing that we want to do in the next 6 weeks is test our thesis and our expert input and our in-field observations with investors, and making sure that we're designing this not in a vacuum, but so that it meets the requirements of buyers who care and who have a requirement to, for example, report in their day-to-day business on the activities of their supply shed or on the activities of the people that they lend to. And understanding what we want to do and what the market requires so that we can then go into, we're really talking late March, April, the iteration process. And when we're iterating, which will be weeks 13 to 18, the sort of Q2 of this period, we'll then have land planning, financial modelling, marketing, collateral and engagement pieces being created, with the idea that May, June, we will be launching to our individual community, our community, not just of the 10 pilot farmers and perhaps a second wave of farmers, but perhaps more broadly. And at that point, we will be able to describe a tested thesis. We'll have a short video that describes what we're trying to do as a grand vision and what are the interventions and what are the management actions and how will we measure that and what success looks like. And also understand a bit more what the generalized financial model looks like. So who pays for what outcome and how does that work within a stack? So maybe not every farmer is going to do every type of intervention and therefore not achieve every type of outcome and therefore not get every type of reward. But of those things that the farmers can individually do within their practices, within their enterprise, within their farm, what does that financial model look like? And we are very fortunate to have support beyond the Landscape Impact Program to help the first 10 farmers actually go from that abstracted result that we get from the Landscape Impact Program into a CER ready position, so that they're ready to plant trees, get carbon, or do soil carbon and register with the Clean Energy Regulator, or engage with biodiversity or hydrology markets as they emerge. So it is very exciting. We do have a plan for you. We've definitely been working hard in the background to improve the quality of the resources for the working team so that you not only have your Google Drive, which you'll be familiar with, your Miro board, which you'll be familiar with, and the project control sheet. But in addition, we've now also got a little website that we're going to use each week. And each week we'll use that website to know, well, this is the content that we're doing this week. These are the milestones. Here's some instructions for our in session. Here's the instructions for the out of session. And you'll be able to enjoy a bit more knowledge about what's coming down the track. But we're not sharing 20 weeks of the program up front. That's probably too much because we know there are some eager beavers that want to run to the end and start from there and work backwards. But that kind of rules out the whole idea of co-design, which is week by week building up our ongoing picture, building together as a working team of 5, and bringing in the input, not just from our pilot 10 of farmers, but now bringing in the inputs that we get from our field trip, from our experts, from our investor session, and from our constant iteration. And so I'm really looking forward to the next few months. There's going to be a lot of travel. There's going to be a lot of work. We're certainly going to be lifting the intensity from comparative to the first 6 weeks where we were sort of getting together and we were getting our thesis defined. Now we start to do the real work, and you can expect to spend an hour to 2 in person each week, and on average an hour to 2 outside of the session working each week. And that's for a 5-person team. So it's going to start to lift in intensity. Our payments for your participation in the working team will happen in week 10, which is assuming that everybody has their in-field session in week 9. Not only will we start to pay our experts, but we'll start to pay the working team for having completed halfway through the landscape impact program, with the second payment at the end of the program. Okay, before I switch tacts and ask Rohan to please address us about the markets, has anybody got a burning question that has been affecting them or the performance of their group between Christmas and the break that we've had and now that they want to address? Otherwise, I've had my opportunity to speak with the Upper Clarence this week. We've got Western Murray teed up for Thursday as usual. What I don't have in the diary is a weekly recurring meeting for the Northern Rivers or a weekly recurring meeting for the Southern Tablelands. So 2 parts to that. One is I need Southern Tablelands and Northern Rivers to determine when you want to meet on a weekly basis and to advise me. It can be the same time as we were working last year, or it can be a different time depending on your schedules, but we need to lock that in and we need to start that ASAP. And the second part of my diatribe was, does anybody have a burning question that they wish to ask before we switch to the market side of things? Looking around, no one seems to be putting their hand up. I'm going to take silence as golden. And please also forgive me for sounding like a snot bag. I've got COVID. I recently returned from overseas, and the big can of farts gave me COVID, and it's a joy, I can tell you. So, Rohan, I've made you a co-host. I'm going to pass the conch to you. I know you've got a presentation, but over to you, mate. Good luck.
Yep. And if I sound a little bit weird, or if I start dribbling, that's because I've just been to the dentist. I'm still kind of numb on the face. Anyway, apologies for the speech impediment. All right, let's go to the deck. Now, just in terms of how we can engage with this, if you've got, I'll try and avoid using jargon, yeah, but sometimes you don't even know you're using it. If you've got any questions or any, might want to drop them in the chat as I go through. I'm going to go through pretty quickly for the purposes of, I'll just try and say one thing per slide almost, so we can run through it, and then we can have some questions afterwards, perhaps, because you can kind of get more colour through the questions. So when we're talking market update, there's kind of 5 ways that farmers can be incentivised, if you like, for delivering environmental outcomes. And we're going to talk to 3 of them: green finance, supply chains, and environmental markets. So leave out government incentives and productivity kind of implications. So looking at supply chains. So supply chains are being driven by incoming reporting requirements. So this is, sorry, it's my dog. Globally, there's a reporting requirements being brought on, companies operate globally, and they're being implemented in different country jurisdictions. In Australia, we've got the Australian Sustainability Reporting Standard starting from July of 24 this year. So companies who are reporting under that will be reporting scope 1 and 2 emissions this year. Next year, they'll include scope 3, for example. So there's a reporting requirement that's being brought in by these regulations that are being imposed on companies. And so in terms of what are they reporting, they are reporting climate. Climate's kind of ubiquitous now, and it's been around for a while. So, but like particularly for the larger companies, they've been reporting their carbon emissions for a while. What's new is they're looking to push down to report against scope 3 emissions. So you would have seen a lot of activity regarding corporates looking to find out what the emissions of some of their farming, trying to work out how to calculate or capture the emissions of the farms in their supply sheds. The other important thing that's coming in is that in the same way that we've had reporting requirements for carbon, we're on the cusp of getting reporting requirements for land, biodiversity, water, basically. And one of the interesting implications of expanding the scope to include those type of biodiversity outcomes is that the folk recognise that you need to work in landscapes. So rather than where carbon can be addressed on an individual kind of farmer basis, if you like, to address landscapes, supply chains are needing to look at whole of value chain impacts. They need to engage stakeholders across their supply shed or landscapes, and they need to report on location data where their supply chains are materially impacting landscapes. So it means that this type of approach that we've got, where we're working collaboratively, fits perfectly with the emerging landscape that's required by the science-based targets for nature. And so it means that we need farmer participation. Just one kind of description about or explanation about the 2 ways that farmers can be engaged. When we talk ACCUs, carbon credits, typically we're talking about creating a carbon credit that's under a recognised methodology that can be sold to any buyer, basically. And so they could be bought, as you will see later, the buyers under the safeguard mechanism are typically oil and gas or pollution-based companies, coal miners. Those guys, so an offset enables a credit to be sold to those buyers so they can offset their emissions. When we're talking inset, which is what supply chains are looking to do more and more, that's where they engage their supply chain and the companies and operators within their supply to directly influence the carbon emissions across the supply chain. So it's the difference between selling a carbon credit to an oil and gas company or engaging with your supply chain and going, right, we'll get some finance to do carbon transactions, and the carbon outcomes will be sequestered and passed through to the supply chain. Another implication of this insetting is, you see this theme kind of emerging, is that it requires collaboration. So that so when a large corporate's looking to engage with its supply chain, it recognises it has to engage many farmers. So, for example, we're working with McDonald's or the McDonald's beef supply chain, and they're looking to support hubs of farmers in regions to try and explore how insetting can occur so that they can kind of reduce the emissions across their supply chain, their scope 3 emissions. So again, it's a good fit for this type of process, and it's a good fit for a mutual that kind of is infrastructure that enables groups to leverage kind of its capabilities. So what does this mean for farmers? In short, effectively, what from a supply chain perspective, farmers will not only sell a produce, they'll be selling how they produce something. So farmers will need to be able to prove or to verify how they've actually delivered the outcome, the produce, if you like. How was it made? And supply chains ultimately will incentivize good practices in inverted commas via either market access and preferential pricing. So someone like Greenham's is already doing this in some ways with their accredited sustainability program. Joe, you can talk to Casino, but like Greenham's offer if you become accredited under that program, you'll get preferred pricing or premium pricing. It also means that supply chains need credible data with respect to the farming impacts within their supply chain, which leads nicely to, we just wanted to touch on our DAF traceability project because we think it's pretty fundamental. It represents a fundamental change. So the idea that we're selling more than our produce. So on the left-hand side, we've got the farmer selling the produce. What we're under our project with the Australian Farm Institute and Standards Australia and a company called GoSource. GoSource, a tech provider that work with governments globally and the UN. So they're working with the UN on a traceability protocol to enable long supply chains globally to better deliver into their traceability. And what it's about is enabling verified claims to be passed down supply chains. So the way a supply chain needs to operate in order to understand what's going on with it is each step of the supply chain needs to be able to say very clearly what they did and to be able to pass that information on. So, for example, a farmer can use a digital twin to capture data with respect to their carbon emissions. They can allocate those carbon emissions to a cow and make a claim with respect to that. That claim can be verified by someone like a mutual who's a trust anchor. So they can share that data with all their data with a mutual, a trusted party. And that party who's accredited can issue a verified claim saying this claim has been verified. And so a small portion of the data, so this cow has X number of emissions associated with it, and it is, and that claim's been certified, gets passed to a digital passport, and that passport can then be attached to the cow, so that when you sell the cow, the ear tag of the cow has effectively the data associated with it that can be passed down the supply chain. And every step of the supply chain kind of does the similar type thing. And so I was going to run you through a quick example, like, I might as well because I'm here. If you were to grab that you can grab an app by grabbing that QR code on the right, and on using that app, you can scan that barcode, and what you'll get is this verified credential. So this is the ear tag of the cow, and it's coming up with the credential information. This is a demo, and it's saying, well, okay, Pete's Meats, a processor, is reporting here, and this because it's their batch of meat, and they're saying this batch of meat came from here. And here's the cow it came from, and here's the output. And if I would just click on the cow, that's their ear tag number. I'm getting taken through to that cow's digital passport. And it's like, oh, all right, that cow came from Fabulous Feeders. And here's some information about that cow. And if I wanted to have sustainability information with respect to it, so this cow came from a deforestation-free farm, there's the little bit of data. If that data was carbon, it would say there's this many emissions associated with this cow, for example. So it's important to realise that what we're talking about here is this is a verified claim, and this is issued by Regen Farmers Mutual saying you've been certified. You've got a verified claim being issued, and there's a bit of data that goes with it. And so that allows the whole supply chain to both report on impacts and to do so in a credible manner. And so the key takeaway here is what we've now got is a mechanism to pay incentives to farmers through supply chains, because when you deliver your verified claim, you can expect to receive a benefit for doing so. So we think that's important. So supply chains, we're seeing that. It'd be interesting to hear others' thoughts, but we're seeing that change coming, and we recognise that change in terms of traceability is happening on a global basis. And so supply chains are looking to respond but do so. And the other key point is they're looking to respond, but they're doing so through insetting rather than offsetting. So someone like McDonald's, for example, is explicit about we want to inset, we don't want to offset. So in terms of green finance, you'd be probably pretty familiar that like banks have been grappling with what their role is in this new world, and they've all of them have come up with these green loans, but like there hasn't been great take up. Be fair to say, that's talking to all the majors, and and effectively that's because there isn't really a material incentive in these green loans. The green loans are particularly supposed to be used for sustainable projects. So whether you're doing a carbon project or some sort of restoration project, and the actual incentive is pretty low. The other thing is that in carbon markets in particular, banks have been struggling a bit to work out what it means to have a carbon project on a farm they've lent money to. So they've been struggling to work out how eligible interest holder consents can be done efficiently. And we've seen that across a number of banks. Finally, the other major big trend is banks are on the hunt for data. So banks need data in order to be able to effectively assess risks, and they're tending to at the moment gravitate to kind of remote sensing type approaches. And Luke here can talk to that because he was actually working in an organisation that was using remote sensing. So it'd be interesting to get his views. But what we can see is that so there's 115 billion in debt across to the ag sector. And when you think about it, ultimately, it might be 3, 5, 10 years, however long it takes to transition, all that debt will be subject to some sort of filter or application of green metrics. But because the banks are looking to collect that data and they're responsible for reporting. And so the best analogy for that is if you look at the coal sector, for example, the Australian banks have stopped banking the coal sector because they didn't want to actually be kind of lending money to a sector that was polluting. You can see that type of approach, that type of thinking will be applied more broadly, that they will look to be, we've already heard this from one of the global banks, that they will look to be selective about who they bank. And so they will look to collect data to be able to manage their risks. This is the way banks always work. They'll manage their risk book. So they'll choose, if you qualify for risking for a loan, then you've met their risk criteria. But in order to meet that risk criteria, they may well need some data with respect to your environmental practices. And then they'll compete for your business on price. And that's where you'll get the incentives. So we think that those verified claims that we're enabling through the supply chain project before, we've been talking to the banks about this, and we can see that they're particularly interested in that type of approach, where they're piggybacking off what other supply chains are already doing. So key takeaway is that banks will transition to applying green metrics to their total loan books in all probability. So on to environmental markets. We're going to talk about carbon and biodiversity. Key thing is, in terms of carbon, it's really important to realise effectively it's a compliance market globally. It's the same in Australia, but globally compliance credit markets, that means they're buyers of those credits are compelled to buy them. The total value of those is 850 billion, in 2021. Voluntary markets globally were 10 billion. So you can see they're piddling. So while voluntary markets get a lot of headlines, they're not big globally, and the same goes for Australia. The other point to note is that prices reflect the regulatory regime. So 80% of global markets by value are European market, is the European market. And the reason for that is they've regulated their polluters to increasingly buy on a constrained supply, basically, because they have to buy European credits. And so you can see that that's reflected in the price. So just one other point on the global prices. Renewable energy projects in, Southeast Asia, dirt cheap. That's where a lot of Australian voluntary credits are bought. But globally, agriculture and forestry carbon credits trade at a premium. So it's just kind of a worthwhile noting. Similar in Australia, HIR, for example, trades at a premium to renewable projects locally. So in terms of the Australian market, again, it's really driven by compliance. So the electricity market, we've got coal-driven power in Australia. The expectations are for that to all switch to solar and wind by 2035. I'm not sure how that's going to happen, but anyway, we'll take it as granted. So this line's going to these emissions are going to drop. The safeguard mechanism are the 115, 215, large buyers, polluters in the country that are required to buy. And so that's just starting to come into effect now. Transport, we've got, that's our, everyone driving, like the transport sector, that's got a fuel excise. So the idea is that's incentivizing people to switch to lower emitting ways of transport. And they put agriculture up here. So that's, as you'll see, we'll go through the sources in a sec, but agriculture is viewed as an opt-in because agriculture can take advantage of the ACCU system, ERF system, to be able to issue carbon credits. So it's viewed as an opt-in incentive structure. In terms of the way that they're split across the ag sector, it's enteric emissions, you can, in terms of where our emissions come from, which is no surprise. And you can see the decline in the sheep flock across that period. In terms of demand, the way the ACCU market has worked has been the government's been the primary buyer up until recently. And you can see that voluntary markets were negligible. And in terms of that's voluntary buying of ACCUs. Our voluntary markets, 90% of the volume were those cheap offshore credits, and they'd mix them with a little bit of Australian credits so they could say that we're saving a cow, or sorry, a koala. And which is perfectly reasonable in the sense of, like, if you think about it, if a corporate is buying a voluntary credit, it's coming straight out of their bottom line. So they need to find, they need to optimize that, I suppose, from a price perspective. Anyway, the point being, up until now, government's been the biggest buyer. But in terms of the forecast going forward, this is from EY, or DQ, it's moving to the safeguard mechanism. So we're going to look a lot more like the European market, where we've got large buyers who will be driving the demand, the primary source of demand. And so it's one thing we've got different schools of thought within the mutual as to some members who would be happy to sell into, to buyers who are members of the safeguard mechanism, as in polluters. And we've got others who are, somewhat ambivalent about that. So it's good to recognise that those guys are the kind of primary buyers for ACCUs. There's a question mark as to whether voluntary markets will kind of switch more to ACCUs over time, maybe by pressure from their consumer base, because the buying of cheap credits from offshore kind of discredits their activity somewhat. So they have to be careful of greenwashing. In terms of supply, the thought is that in order to activate the supply that is required to meet that demand that we've just seen, that the price needs to rise through $50 over time. And in terms of where it's coming from growing trees. Vegetation is the thought of where it'll be. You have to remember that because most carbon credit supply takes 5 to 10 years to arrive, unless you've got an avoided clearing project. The majority, you do the investment up front, and then, for example, your trees reach that peak carbon sequestration period through that 5 to 10 year period. So the carbon credits being bought today, over half of them that are being bought, like the covering emissions today, were from projects from pre-2020, for example. In terms of like ACCU prices, so historically carbon credit prices, they had a bit of a fall back during the coalition government, when the coalition realised that the way the scheme had been set up, there was a kind of an exit mechanism for the existing project owners who had sold into the ERF. They had effectively a way to walk away from their contracts. And so at this point in time, the carbon price was 55, and then the government realised that they could actually walk away from their contracts with little or no penalty. The way that they'd have to pay the fixed price, which was $25 basically. So effectively, the price fell to the price that that they would have had to pay the government, which makes sense because that windfall gain. And so the price has been hovering around that 25 to 35 since then. It's now about $38 for HIR. But the thing is that the safeguards mechanism's just starting to kick in. And so you're seeing there's a few lines on this page. The black one, I think, is the I can't see the bottom of the page there, but is it Ernst & Young? Yes, that's the Ernst & Young forecasts, and the red one is Reputex, which are the carbon information system. One of the poor things about our carbon market is it lacks transparency. It's appalling that the primary participants, who are the brokers who kind of control the market, it's not in their interest to have a transparent market because they make their margin by buying from one person and selling to another. So it's not in their interest to have a transparent market. So it's very difficult to get these prices. The forecasts are, well, they're forecasts, but if you're talking about historical prices, they're spot prices that are reported. They're like small volumes compared to what's being actually traded through the market. Anyway, so Reputex is an information service that exists because they provide some sort of way for the market to provide some sense of transparency. Price, you can see it going through $50 after as we head through towards 2030. One thing to note: carbon plus co-benefits. There are premiums, or have been premiums paid for carbon accus in the voluntary market. We don't know exactly what they are because they don't get disclosed publicly. But talking to someone like Tasman Environmental, who are one of great guys, one of Australia's leading carbon brokers, we were talking to them last year, Audie, and I think it was like a $40 or $50 premium they got for the carbon credits that they were selling for Arnhem Land, which had cultural credits associated with it. So that there was a cultural benefit and perhaps a biodiversity benefit. There was this co-benefit that was associated, and they were able to get a pretty significant premium in volume. The LRF, of course, in Queensland has a co-benefit scheme, which is transparent. And the way that works is you have to have a carbon project, and then they've put together a standard. And if you once a year, historically, it's been, they open up the LRF fund, and they have a round where they fund biodiversity projects. So you can have a biodiversity project that meets their criteria that sits atop your carbon project, and you can get a premium through that process. And we've got one of our council members has got a LRF project on his land, and he got effectively equivalent $80 a tonne or thereabouts, 90? No, $90 a tonne for his koala kind of co-benefit. Which steps us into biodiversity markets. Now, biodiversity markets, as Gavin kind of pointed to right at the start, like they're emergent, like in terms of voluntary markets anyway. PwC did some great work in trying to quantify how big this market might be in the future. It's a bit hard to work out, even reading the text of the document, what each of these categories are. But I can imagine sustainable commodities might be supply chains. Biodiversity offsets, well, that's an existing market, and that's actually growing. Well, Simon, you'd probably better to be able to kind of describe what the size of that market is currently in New South Wales. But the thought being that the biodiversity market could be significant. In terms of the offset market, so again, this concept of offsets and insets will apply in biodiversity land as well, so insets for supply chains. So in Australia, each of the states has well-recognised biodiversity offset schemes, and they're world leading in some senses, in the sense that they're pretty well described. They're not necessarily they're complicated in Australia. In New South Wales, I think there's some huge number of community classes. So like you've got different types of credits depending on either the flora or fauna that is associated with your land. But the way these work are, you enter into a biodiversity stewardship agreement, and the biodiversity stewardship agreement is effectively an agreement that's registered on your title that says you will do certain things on this land, and it's in perpetuity. And it needs to be in perpetuity because the buyers of these biodiversity credits are needing to offset their activities. So typically they're cutting down a tree in one place, so they need to buy a tree in another place. And so it needs to be in perpetuity because that's the purpose of the offset. The problem with these offsets is that they're effectively halving our natural estate, because we're actually, they're having to buy it because they're cutting down a tree somewhere. And so effectively there was 2 trees, you put a permanent protection for one of them, but you've cut down the other one. And so these have you'll see in the nature repair market. No, okay, it's not next slide. But the nature repair market doesn't allow for offsets for exactly that reason. And the idea is Australia's, the Commonwealth Government signed us up to be nature positive by 2050. And in order to be nature positive, you need to find a way to, one, if someone's entering into a biodiversity offset, they ultimately, we can see that like it's going to be, whether it's 3 years or less, that person entering an offset will also be required to enter into some sort of credit that creates a nature positive kind of outcome. So first up equals what they've destroyed, and then quite possibly creates a nature positive kind of outcome above it. So that potentially is a source of demand for biodiversity credits that sit outside the offset regime. In terms of voluntary markets, like we're part of the Biodiversity Credit Alliance, which works with it's come out of the UN. We're working with the World Economic Forum. And so they did a study last year interviewing global corporates to find out why they would purchase it. And you can see that basically they're saying, well, we'll purchase them when we need to be, when we're told to. So when we need to report on them, we'll be buying them in the same way it's worked in the carbon market. So that's effectively what that chart's saying. And then it's going, well, what outcomes would drive those purchasing decisions? Well, they need credible credits. So they need methodologies. They need it to be verified. They need to know that they're not buying something they're going to be accused of greenwashing about later. That's the key kind of consideration there. And the market, the world's not there yet, which does lead to the nature repair market. So the nature repair market, the government's creating a framework for a voluntary, so it's an infrastructure for a voluntary biodiversity certificate market. As I said before, these certificates cannot be used for offsets, but in a sense, what they're trying to do is to create the rigor that will allow for those types of buyers of nature positive outcomes to emerge. And where it's currently at, so we're relatively close to this because we meet with DQ pretty regularly, and we have a project. I'll talk to it in a sec. And so we're talking to ANU yesterday, and they were retained to do the monitoring framework that'll inform the nature repair market. And so they've only just finished that work, and that work's going to DQ, I think it went earlier this week, and we'll actually get a copy of it shortly. In that work, that monitoring framework, they've got a case study using the box gum grassy woodland. And that case study is what we were hoping, we're still semi-hopeful, we'll be able to use that to build a methodology for box gum grassy woodland around. Because one of the things that we're looking to do in order to try and help catalyse the market for biodiversity credits is to participate in the World Economic Forum Biodiversity Credit Auction. And this is scheduled to occur in the second quarter of this year. And it's likely to occur then because they've got McKinsey's advising them, and McKinsey's are doing it pro bono. And so therefore they're pushing to do it sooner rather than later. The point being, we've submitted a native woodland credit on the assumption we will have a methodology that we can build on. And we're hoping that the work that ANU's done will help us to build that methodology. Ideally, ANU, so that's our challenge. We need to solve that problem about credibility. The real thing that we're trying to do here is to understand what the demand for this type of credit is. That's our real objective, because like this thing is going to take a while to emerge. But what we want to do is to test these credits with potential those current offset buyers. We want to see how they respond to what we see as an emerging need for them. And we also want to test them with supply chains. And as I say, our expectations are supply chains will go, we want to embed this in our in-setting. Anyway, key takeaways, 2 slides, that supply chains are gravitating to in-setting, right? So they're not necessarily interested in ACCUs. They're interested in methodologies. They're still approved methodologies, but methodologies with lower barriers. So it'll be lower barrier, simpler for a farmer to execute, but in all probability, lower financial returns. There's going to be a trade-off, and there's some sort of sense of you've got some commitment to, or stronger commitment to that supply chain or that particular buyer. In terms of selling ACCUs, the idea of the safeguard mechanisms kicking in and those polluters buying, there's something to be worked through there. It'd be great if the voluntary market were to kind of supplement that, and there'd be a bigger market kind of grow around that, but we can't bank on it. And co-benefits, they're hard to assess when they're bundled. We would prefer if biodiversity was kind of split out, because then we can look at it and try and get that bit valued independently. So biodiversity markets are absolutely emergent. They're, as I was trying to say just before, what we would like to understand at this point in time is how buyers, how capital is going to respond. And so one of the opportunities through these landscape impact programs, when we have the investor day, if we can find a way to start that conversation with some relevant folk, that would be good. Again, we need, like, it is subject to having methodologies that the buyers can actually go, yes, I can hang my hat that I'm not being, sold something that doesn't exist. So there you go. I don't know how long it took, but
Thank you, Rohan. Probably at this stage, I see a lot of people holding their heads in their hands, and I think they're probably deep in thought. And there might be some people needing to ask clarifying questions and getting you to restate some of those questions that you had, because we went through quite quickly. So I want to say there's no such thing as a dumb question. Rohan did have to move necessarily fast to cover a lot of ground. I would invite questions from the floor.
I'll have one.
Go, Jack.
Yeah, thank you. When it comes to carbon, so the summary of that was that there's going to be a lot of momentum on insetting for supply chains. They'll want lower barriers, and there'll be lower financial returns. Do you think that is really going to be something that farmers wanting to focus on? They might be concentrating on that because there'll be the momentum will be faster than the safeguard mechanism kicking in. When you have a look at those timelines on some of those graphs that were flashed up, the supply chain impetus is fairly urgent when you have a look at those international accounting standards and other things coming to pass this year and next year. Do you think that's something that we might, because we'll need to triage our time and efforts and resources, be focusing on primarily is both proactive and defensive look at the supply chains?
Good question. So a couple of things. So starting with the concept of when, let's assume that we're doing planting projects, because that's, I think, talking to Wardy before, probably the core cohort of potential opportunities. But like recognizing that like 5 to 10 years before those carbon credits that will be generated from those projects will be available for sale on the market. You might want to sell them forward or what have you, but like it's not going to meet a near-term supply chain problem in a sense. But that might be okay, because like supply chains are a little bit more, their driver is to be able to report on what they're doing to address their the emissions embedded in their supply chain. So their approach will be, this is emergent, but like project I didn't mention is we're working with WWF Australia to get funding for another 20 landscape impact programs starting in July. But the idea behind that will be to get funding from corporates because they're the ones that want to actually bring farmers together to understand what I can do in my supply share. So the benefit of that is potentially it solves the upfront funding cost at the same time. So that one of the challenges with an ACCU type approach is, like, in some senses, there's an ACCU, doing an ACCU project on your farm is really quite an independent activity. You know, regen farmers will be able to deliver economies of scale. There's no doubt that, like, if we were able to bring a cohort of farmers together in a landscape, and they were all doing a carbon project independently, but we'd be able to actually kind of have the mechanism to drive down the per unit costs. Yeah. So, but an ACCU project is in some ways offers a farmer greater agency than if you're working in your supply chain. You're kind of working with them. It might be a processor who's saying, right, okay, I'm bringing all of my farmers together, and you're collectively going to do this thing, and the benefits of that are going to flow through the supply chain. You might get a premium for your output, but it'll be kind of more intimate. Sorry, I don't think the word I'm trying. Yeah, it'll be more locked in, if you like.
Yeah, yeah. And I guess that's the thing, is that so much more control by the supply chains of what you are, and also, you know, will regulation meet all of this if the control becomes more perverse because they don't have the supply that they need, so they put pressure internally on, you know, internal carbon taxes. Yeah, I think there is some danger.
So one of the, we've been talking to them, so because, like, oftentimes large corporates will have an internal carbon price, which I guess is the same as an internal, that's the internal carbon tax. But one of the things we've been, like, again, in talking to WWF, we've made it abundantly clear our members can't be screwed over by, you know, entering into this kind of thing. And so, no. And so our objective would enable farmers to have the option. So it might be the low-cost path of least resistance is to do the supply chain, but in the event that you wanted to step away and do something else, that you can then. So it's not a 25-year commitment. Like, so McDonald's, for example, is talking about an annual commitment. So it might be different like that.
Which is why that traceability is so key. If you're going to swap between projects or, you know, or trains, then yeah, keeping that keeping what you're producing with high traceability means that you do have more freedom.
That's what we reckon that is game changing from a farm perspective, because you've got the power, then you've got the actual produce, and you've got the information they need.
Yeah.
In order to be able to report, and that can be used by banks, government, but in order to get access to it, they need to deal with you.
Yeah, so, and that's it, and also just preventing. That was what he's saying about supply chains sort of either docking your what they're paying you, or sending you a bill, having, you know, sort of assessed you from a satellite above, or done an aggregate across the supply chain, and you're sort of lumped in with other people's practices as an average or mean.
Yep.
Well done, Rohan. Well done. Justin, you had your hand up.
So I feel like I'm getting a really good picture of, you know, how as farmers and on this side of generating some kind of positive impact, I'm getting a good picture of how we're going to build that all together. What I'm still struggling to understand is when you're talking about the international climate standards and accounting standards and all of that, and when you're saying they're being implemented or brought in or whatever, obviously they're going to be guiding what they're expecting us to do, but I'm still not sure, like, where comes in, like, what's making them do that, like whether it's going to be like the government charging companies money for not do, like, what's going to happen if a big company decides not to follow the standard for some reason, or, you know, whatever? Is there a government that going to charge them? Are they expecting that just the public are going to not buy their stuff, or yeah, I'm still not really sure about all of that part of it. Like, if someone's not complying, what's going to happen to them?
It's going to be probably a bit of all of the above, so to speak. So deforestation, for example, deforestation, there's clear. Well, it's actually not clear, believe it or not. You'd think like it'd be pretty clear kind of measure. It's like, have you cut down a tree or not? But apparently, but the way they go about measuring, clearing is different within. So in Europe, there's one measure, but we've got a couple over here. And anyway, so there's work being done on, well, how do we kind of standardize that? But the long story short is that there is requirements around deforestation. You cannot buy you need to buy deforestation-free beef, for example. So if you're going to export to Europe, so that's a regulation type approach. If you're going to export canola to Germany for renewable energy, you need to have an ISCC certificate. So that's a whatever it's International Sustainability Standard certificate. So there's going to be some buyers that require some markets that require certain things, but in terms of the consumer side, like for someone like McDonald's, they are kind of, if you look at their they've been doing sustainability reporting for years, as you can imagine, and you can see that they've been reporting on, we're doing this thing, we're 97% deforestation free, in 2018, what have you. So they're wanting to improve. The IFRS accounting standards, so they're the International Financial Reporting Standards that are driving so that's the global kind of standard, if you like, that Australia has grabbed that and applied it, that we've tailored it for our local, it's only just being done now, but we've tailored it for our local market, so it's the Australian Sustainability Reporting Standard. The global one says you need to, as a corporate, see if I can remember this, you need to understand what your emissions are. You need to have a strategy about what you're going to do about them. You need to have clear metrics, so therefore on how you measure your performance about what you're doing about it. And then you need a governance structure, so you need to be able to kind of, I'm not exactly sure what that means in this context, but so they're quite specific about the types of reporting. And I guess once you actually measure something, the transparency leads those global corporates to actually start going, right, well, therefore, we want to actually go from. And then on top of that, then there's the net zero pledges. So good example. So there's been this net zero by 2030 pledge that global corporates been signing up to. With the transparency protocol, for example, the strategy there for getting that adopted globally is quite similar, where the UN has a pledge, will have a pledge page, and it's going out to governments and corporates, global corporates, saying, will you pledge to adopt this by whatever time period? And so there's a strategy to kind of get, to market that, so they're actually signing up to a UN standard recommendation. So that type of thing is the way it kind of rolls out, if you like.
I might jump in there too as well, Rohan. Justin, I'll rephrase what Rohan's saying. Regulation means that if they don't do it, either they can't sell to that market or they'll be penalized with regulation, as in they could go to jail, spend time, getting fines for breaking a regulation. The other is wholesale finance. So the cost of finance, like these large organizations like McDonald's is raising, let's say, $100 billion bond. The cost of that bond, the amount that they will have to pay in interest, if they are IFRS compliant, will be much less than if they're IFRS non-compliant. So they'll have to pay a bigger interest rate if they aren't being compliant with the financial reporting standards. So that's
as in to a bank or to the government.
Exactly. So banks and governments both get wholesale finance through bonds, raising bonds essentially, and a bond that's compliant with IFRS will cost you less in interest than one that's not. So whether you're a government or you're a large organization with a supply chain, it's in your interest, as in literally the interest you'll pay when you're raising your next bond, to be IFRS compliant. And in order for you to be IFRS compliant, you'll need to meet those regulations. So there's like a financial penalty if you're not IFRS compliant, and there'll be regulation penalties, as in you can't sell that product if it's not deforestation free, or scope 3 emissions around that product aren't clear and transparent. So there'll be 2 sticks, but there are sticks in place to make the buyers buy. That's what when.
So can I?
Sorry, Wendy.
Sorry, Woody. I was just going to ask. Then the collectors of the penalties, what happens to that money? Where does it go? What's it used for? For what purpose?
So
are there people who are going to profit out of those penalties?
So there's a penalty in terms of exporting to Europe is called a carbon border adjustment mechanism, right? So if you are selling carbon intense beef into Europe when the European beef producer has had to comply with their local standards, whereas if you're from Brazil or Australia, or you're trying to sell beef into Europe and you haven't had to, they will collect a tariff at the border for that ton of beef. And what that does is enable those beef producers, that industry, to buy locally the European carbon tons equivalent to make your beef import on a par with the beef that was produced locally in Europe. So that's how an example of those regulations. In terms of those interest rate differences, it's whoever's lending them the money, right?
So if the penalty is collected in the terms of the tariff, then that can, in theory, be fed back into the system for
the local community. So Europe has its regulations and it's applying it to importing, countries that want to export to them, and then it'll collect that carbon border adjustment money, and it'll bring that into its country and it will spend it to, accordingly. So it won't come to the farmer, put it that way.
No, and I wonder how much of that money will disappear through the system too.
Well, who knows? And you can't control it if you did know. You're not a part of the European Parliament or even a European citizen. You don't get a vote. It's not your country, Australia doesn't have any carbon border adjustment mechanisms or anything in place.
So do you foresee through these mechanisms that possibly, if farmers don't get on board, then they may end up just being shut right out of being a producer altogether because they can't meet the standards, and then maybe even supply chains running out of their supply, or not running out, but like really decreasing their supply available if they can only accept people that are complying?
I mean, the logic works in this way, I think. So Australia has 70% of the McDonald's beef patties globally. The other 30% is probably Argentina and Brazil, right? Now, in order for McDonald's to continue to be IFRS compliant and meet all of its reporting obligations, it's asking that, it knows its carbon emissions per patty, and it knows whether it's deforestation free and biodiversity and animal welfare, a whole bunch of standards. And if Australian farmers can't tell their processor, Greenham's or Casino or any of the processors between Townsville and Tasmania, what's going on, and those processors can't tell McDonald's, then McDonald's will ultimately buy more beef for its patties from Brazil and Argentina, assuming that Brazil and Argentina can provide that information. And if Brazil, Argentina, and Australia can't provide that information and America can, well, then America will start to be the place that can provide the beef that enables McDonald's to produce those patties. So you'll see a massive imposition move down the supply chain. Sorry, Rohan, this is you want to talk to that?
No, so the way it'll probably roll out is that, recognising the top 10% of beef producers produce 60% of Australia's beef. Right, so it's the large end of town will meet because their major customers are going to be the kind of likely to be the large consumers. Yeah. So it starts with there and then kind of rolls down, but it doesn't mean to say that, like, if you're a small producer who doesn't, he doesn't sell in those supply chains, if you're selling locally, well, you're kind of outside the system to some degree, aren't you? It may be that, but we can see that traceability, once this traceability kind of infrastructure starts to become commonplace, and some of the data is remote sensed, there's no doubt about it. The people can't help themselves. They've got a satellite up there, they're going to go right. And so there's going to be some remote sensing of all Australia's, about my backyard kind of thing. So even you can imagine a world where it goes beyond supply chains, it goes to the banks, it goes to with government grants, for example. You can imagine the government grant program, which is looking to incentivise certain actions, might go, right, we want you to do these actions, and the quickest way to report on that is to use this traceability kind of infrastructure, because it provides for seamless, credible way to actually kind of pass the data that the government needs to report against its grants. So you can kind of imagine a world where every farmer might be touched by it, but you still operate without needing to necessarily adopt all the standards.
Rohan, can I say in the context of that this insetting versus offsetting, it makes me feel really, really uncomfortable as a farmer, really, really uncomfortable. This idea that we're going to have so much of this insetting. The easy option is going to be, as Jackie said, to force everything down the supply chain onto us, isn't it? And what happens, I suppose, if we sign off, we do our carbon accounting and sign off our ACCUs and into biodiversity, offsetting biodiversity markets, but then our supply chain turns around and says to us, well, we're going to pass off insetting onto you, and we've got nothing left to trade with. I suppose it means we have to get out of those supply chain systems and start our own. Is that how you see things are going to go?
The way it's currently is developing. Remembering that insetting, it's been around for a while, but it hasn't really taken off, as yet. And the way it's being developed is through collaboration with groups of farmers, because I think that the likes of Casino Co-op and the mutual necessary infrastructure to be a countervailing force, so that they've got someone to negotiate with in some ways, because the likes of the MLA, which are funded by levies, aren't necessarily, they tend to be, they're driven by different motivations, if you like. So I think that insetting isn't going to be forced upon you. I don't know, whether 20 years down the track, whether it's just commonplace. But insetting isn't going to be forced upon you right now. It's going to be, do you want to join this project with this particular supply chain that's looking to do this, and they're offering these. We'll explore how they would go about setting up an insetting scheme. When we've spoken to Fulton's market group, we've said, well, we can't have our farmers being locked into it. We've gone, no, be done on an annual basis. And like the methodology we'd use would be this, which would allow for McDonald's to report against its emissions targets, but it's a lower bar than the ACCU kind of scheme, but it wouldn't stop the farmer from then going, right, I'm opting out of that. I'm going to get out of beef. I'm going to go into something else and use the trees for an ACCU scheme, for example. So it was, I suppose the objective was to try and, find ways where farmers have the optionality of either dialing into a scheme that's emerging in their area or not. Certainly, it's one of the things that you would want to, through this program, you'd want to engage with some suppliers to have this conversation so you can actively kind of explore these issues, I guess.
And another thing to remember is, as farmers, they've got the problem first, right? They've got the large organizations have these Australian accounting standards requirements kicking in this year. As a smaller organization, as a farm business, you don't have these requirements. They've got the problem. You've also got all the ACEs, as in the only thing that brings carbon out of the atmosphere and into either a product, healthy soils, habitat and trees within the landscape is photosynthesis, and only farmers have that. So getting together as a landscape, inviting your supply chain to the investor sessions in the next 6 weeks and having them tell you what it is that they need in order to meet their requirements and what it is you can do individually and collectively that makes a difference in your environment is the most functional place to start in terms of negotiating what an insetting agreement for carbon, for biodiversity, for water, for habitat looks like. And if you're not collectivizing your negotiating power and your head's in the sand and you're just kind of like, oh, well, I'll join XYZ in setting supply chain program, well, then you're going to be a price taker and a program taker, and you won't have the same degree of flexibility or agency as what we're providing here. But it's important to understand, as farmers, we do hold all the ACEs. Everybody's concerned about the environment and climate, and that is physically on the land that we own. And we have the ability to affect through our practices and our decisions and our management what happens, not just in terms of production, but also environment and climate outcomes on the land that we control and collectively across our landscape and collectively across many landscapes, what happens in the state and Australia. So I think don't go without your agency. Understand that you're already on a pathway to massively increasing your agency here. That's why you're hopefully in the landscape impact program.
I can just rephrase just quickly. I think what Wendy's trying to say is if we go outside of the insetting and put all our ACEs into some kind of offset market, but then your whatever supply chain you're selling into decides that you have to have an ACE to sell to them, but you've already put all your ACEs away, what do you do then?
Well, they've also got this problem, right? It is their problem. And so they've already been in insetting markets going, oh, well, carbon produced in the process of feedlotted beef is above an indexed amount. And so they go off and they buy wind power from Indonesia or Brazilian hydropower or vice versa. I might have got those mixed up, which are tons of carbon dioxide equivalent that enables them to bring down that high grain-fed beef feedlot beef to the low indexation point that they need. They still need to create that carbon neutral beef. What they'll do is they'll calculate the cost of buying that hydropower or wind power and they'll deduct that from what it's costing them to buy the grain-fed beef from you, so that netting out, they're still, you know, making the same amount of margin and they're still getting their net zero commodity. But
it doesn't mean to say also that, like, there might be carbon neutral beef, there might be low emissions beef, there might be just everyday beef. Like, in the same way, like, coal is still being pulled out of the ground and sold to China, notwithstanding the fact, you know, large swaths, you know, it's been pulled out of the ground in Germany and used as power. And so, notwithstanding the fact that lots of people like don't want coal energy, kind of, so there can be different markets for different produce. It doesn't mean to say that there won't be a market. It might be there's just a different price.
I'm aware that we have now cruised through our hour and a half, and I should be winding us up. I guess the reason for bringing the market update is we are now moving from having defined what it is we can do individually and collectively in a landscape. We're going to test now with experts, with in-field work, and with the people that we do business with on the other side of the table, our thesis, and get feedback, right? Like, that's the next 6 weeks. And so this is meant to be an introduction into the process, and I hope it's been informative. We have recorded it, so if you want, you can re-watch and gather any parts that we went over too quickly or went over and you'd like to see again. I do want to thank you all for your participation. I couldn't tell you how excited I was to hear everybody recapping what they're doing in their landscape and what their interventions are. And I'm really looking forward to the next couple of months working together. So without any further ado, thank you, Rohan, for your presentation. Thank you, everybody, for your participation, and we'll speak soon.
Thank you, Woody. Thank you, Rohan.
Thanks, Rohan. Thanks, Wardy.
Everyone.
See you.